Do you have 10 Indian rupees lakh sitting idle in your bank right now? Most retail investors in India start with far less capital today. Yet the urge to double your portfolio in months is overwhelming. That is why option trading and 3x leverage look so tempting. Then Dalal Street delivers a shock that changes everything overnight. In a single crash, 56 Indian rupees lakh crore vanished from Indian markets. The Nifty 50 dropped 33% in a matter of weeks. Panicked retail traders watched their life savings evaporate instantly. For option buyers, capital went down straight to exact zero. Yet one quiet group of investors actually made solid profits. Investors holding basic index funds stayed calm and gained 31%. Because passive index funds do not carry overnight liquidation risk. While active traders panicked, simple SIP holders just sat idle. Staying invested through market cycles beat aggressive leverage. So why do most investors ignore this straightforward solution? The core secret is plain broad index funds without leverage. Buying Nifty 50 or Sensex means buying corporate India whole. You do not bet on individual stock hype or hot themes. No debt, no derivative decay, just real market growth. However, broad index funds hold a hidden structural concentration. Heavyweights like Reliance and TCS drive massive index returns. In fact, 85% of Nifty gains often come from top stocks. When you buy the Nifty, you own India's largest conglomerates. This concentration brings stability without single stock risk. Single stock leverage trading creates an entirely different chaos. Single stock derivatives destroyed over 24 Indian rupees lakh crore recently. Retail traders buying leveraged stock F&O lost 29% daily. Betting on one company with leverage creates total portfolio ruin. The problem was not the stock, but how it was bought. If everyone knows index funds work, why do traders fail? Simple index investing sounds boring to most thrill seekers. Investors know the strategy, yet capital destruction repeats endlessly. 3 behavioral traps guarantee retail losses in every crash. Mathematical drag, broker margin calls, and emotional panic cycles. Let us examine how panic unfolds live on Dalal Street. Circuit breakers halted trading 8 times within 4 months. The Sensex plummeted over 700 points in one trading session. If you have better wealth strategies, share them in comments below. Please like and subscribe to support our financial awareness channel. When trading freezes, regulators enter with emergency restrictions. SEBI raised margin requirements from 10 Indian rupees lakh to 30 Indian rupees lakh. Regulators enforced strict cash collateral rules after massive losses. However, regulatory intervention always comes after wealth is destroyed. You must understand structural market traps to protect yourself. Trap 1 is a mathematical illusion hidden in daily resets. A 10% drop requires an 11.1% gain just to break even. In 2x leveraged products, that daily reset creates math drag. When the underlying index recovers, leverage lags far behind. Volatility permanently erodes capital even in sideways markets. Here is numerical proof of how sideways markets destroy cash. Over 100 volatile days, a 2x fund loses 21% capital. Because daily percentage resets compound losses faster than gains. The index stays flat at 0%, but leverage burns money. Paper folds leave creases that never flatten out completely. If volatility drag does not wipe you out, brokers will. Margin trading debt in India recently hit 32,000 Indian rupees crore. When prices plummet, brokers trigger forced liquidations instantly. They sell your stocks at bottom prices without consent. Over 1,000 senior citizen accounts were forcefully liquidated. Consider how forced liquidations compare to sudden eviction. Margin trading is like a landlord evicting you in 2 days. Even if home prices recover later, you are already homeless. Without debt, you can wait decades for market rebounds. Leverage destroys the element of time needed for compounding. Legendary leaders prove that compounding requires patient time. Ratan Tata built generational trust through steady, patient growth. Similarly, 90% of Warren Buffett's wealth came after age 65. Compounding works like a rolling snowball down a long hill. The final 10 years generate massive exponential wealth expansion. Passive broad indexes outpace even expensive active managers. Data shows 91% of active managers underperform index benchmarks. Index funds automatically remove failing companies and add winners. Instead of nurturing one plant, you buy the whole garden. Yet investors still lose money due to human psychology. Trap 3 reveals the internal emotional impulse to panic. Investor returns lagged fund returns by 1.2% every year. Retail traders buy during market euphoria and sell during crashes. Loss aversion makes financial pain feel twice as severe. The greatest danger to your portfolio is your own emotions. Automated investment structures eliminate dangerous human mistakes. Automated monthly SIPs remove emotional interference entirely. Tax-efficient structures like PPF enforce long-term locking discipline. Auto-debiting on salary day builds wealth without active thought. Locking capital prevents impulsive trades during panic drops. However, Indian investors must also address home bias risks. Investing only in Indian stocks creates severe home bias. Adding global indexes like S&P 500 balances domestic crashes. Dollar appreciation helps offset rupee currency depreciation. True diversification protects portfolios across worldwide markets. Even broad index investors must confront real market risks. Indexes can take decades to break even after crashes. Japan's Nikkei took 34 years to recover 1989 peaks. No investment guarantee exists without patience and time. That's why staying disciplined in simple index funds matters. The ultimate choice remains between quick thrills and wealth. Wealth creation is proven: unleveraged indexes, automated monthly SIPs. Trading leverage provides temporary thrills but guarantees capital ruin. Boring consistency builds quiet fortune across generations. How did your portfolio navigate this recent market volatility? Will you choose disciplined compounding for your future journey?